no further ado, Carlota Perez.
Thank you. Thank you. So, financial bubbles, crisis, and the role of government in unleashing golden ages. I guess, first of all, I want to thank all of you who stayed. Secondly, I think my role in closing this fascinating conference, I think you would all agree to that, is to try to locate everything that has been said in the big picture. And maybe also, because so many of the things are so painful to understand and to realize, maybe to introduce some reasons for historical optimism, perhaps. And the third thing I must do is to try to keep you awake, because it's been a very long day. I hope I'll succeed in that, at least. So, as I said yesterday, the adequacy of the solution to the financial crisis will, of course, depend on the adequacy of the explanation. Now, whatever you think of standard economic theory, it is designed to function in normal circumstances, if at all. But anyway, in normal circumstances. When we need to understand extraordinary times, like the ones we're living now, we cannot do so without interdisciplinarity. So, economics has to be enriched with an understanding of technology, an understanding of institutions, and especially seriously considering history. So that's the wider framework that helps us identify long-term regularities. Of course, the present crisis can be understood on two levels. We can look at the immediate causes, or we can look at it at the underlying causes. So, was it global imbalances, too big to fail, pro-risk incentives, inappropriate regulation, excess liquidity, whatever you can think of? Okay, of course we have to understand that, because otherwise we cannot design effective regulation and financial architecture. I mean, we have to keep that in mind. But the real underlying causes, the question of whether these major once-in-a-half-century collapses are accidental, whether we're talking about black swans, or whether they are in fact endogenous to the market system and pretty much inevitable, that's what I will hold. And that is essential for how to revive the economy and how to unleash a new prosperity. Now, the thing is that because in market economies technical change occurs by revolutions, what we get is pendular swings in capitalism every 2 or 3 decades. So 2 or 3 decades one way, 2 or 3 decades another. We go from a period of financial capitalism for the installation of each technological revolution with unfettered free markets and income polarization, generally trying to get the state out of the way, so you just get going with free markets and finance leading the way, to a period of production capitalism aided by government for the full deployment of the new growth potential across the economy and society. What marks the swing of the pendulum is a major financial collapse like the one we have just had. And the conditions prevailing during the bubble time growth, which is the one we've gone through, become an obstacle to growth from now on. So in fact, the free market ideology is for all intents and purposes now as obsolete as they were saying that the state was obsolete during the 70s and 80s. So, because this is the sort of pendular thing where you have to make such changes. Now, if we look at the historical record, we see that with each technological revolution we have had bubble prosperities, then recessions, then golden ages. If we take the 5 great surges, I call them great surges, long waves, this upswing, downswing of GDP, that doesn't work. But these are surges of technical change that are assimilated by society. There have been 5 of them. And each of them has had, as I was saying, an installation period, then a turning point with the recession when you change, and then a deployment period. So we go from bubble prosperity to collapse and recession to golden age prosperity. That's the good news. Canal mania, after the recession, the big canal panic, is followed by the Great British Leap. Railway mania in the Victorian boom is followed by the Victorian boom. The bubbles of the first globalization, the Bering crisis, Argentina, Australia, New Zealand, in a strange way the US also, they were followed then by the Belle Epoque in Europe and by the so-called progressive era in the USA. The Roaring Twenties, followed by the post-war golden age. This question of whether the bubbles are technological or financial, I really respect Mary's work very much. It's fantastic work. And I want to just clarify something. I cannot discuss it in this little thing, but in 2 sentences I will try. What happens is that it is the new technologies and their successes, a few initial successes, that bring all the excitement. This excitement brings all the money into the stock market. And it brings so much money that that flood turns finance into an innovative casino. And that's what the bubble really is. But the bubble was spurred by the technologies. So what happens in the end is that you get these technologies installed and at the same time this enormous financial wealth concentrated. Polarization of income, etc. So we could go deeper into that, but that's my simple answer for the moment. Then after that, of course, we had the post-war golden age. And we have just had first the internet mania and then the financial casino boom. And we are now in the turning point at that recession period, which lasted 13 years last time. How many years it'll last now, we don't know. It has been very short in other times. But I think we're not doing very well in understanding. But if we could, I think we have ahead the possibility of a global, sustainable golden age. The shift from financial mania and collapse to golden ages is enabled by regulation and policies to shape and widen markets. What we have then, from one period to another, is a shift in the drivers of innovation. In the installation period, we have a supply push period, where you actually finance and the new entrepreneurs are the drivers and innovators of everything that happens, of all the growth that happens then. And at that time, generally, the state plays just a facilitating service role. Before that, as Mariana would insist, and she is right, absolutely right, the gestation of these technologies where finance and the new entrepreneurs innovate has been almost always done. No, not in railways, not, but certainly in the fourth surge, in the one about, no, actually in this one it's obvious. In the others, there is some doubt as to whether the first were done by the state. But now, definitely, and with the modern state, it's inconceivable that it would be any other way. Then we have the deployment period, which is a demand pull period, where it's production and the state that are drivers and innovators. And that includes both the gestation of the future and the innovations that promote the deployment of all that installed potential. Because what happens after the installation period is that's why it's called installation. You have now installed an enormous potential, both in physical technologies and things, like the internet and all the rest, but also in the logic, in the paradigm, in the logic that guides innovation and that guides transformation of companies and transformation of products and processes and everything else. And at that time, finance should go into a facilitating service role. I said I was going to give you some grounds for optimism. This is not one area where I can give it. It's going to be very difficult. And if we don't get that, if we don't get finance capable of facilitating and actually serving the real economy, we're not going to get out of this mess. Maybe the emerging countries will, because they don't have that problem, but the West is going to have trouble. So what the first period is, the installation period, is a vast free market experiment. And what we're now having ahead is the full flourishing of the installed potential with that huge experiment. So during deployment, innovation in production is going to depend on effective institutional and policy innovation. This means a lot of research in what can be done, a lot of social science research, in order to invent these bold, fantastic institutional innovations equivalent to what happened. You know, if you think of everything that Keynes proposed, everything that was done with the Bretton Woods Agreement, such a huge amount of innovation that would have been inconceivable, say, in 1934. So we're talking about pretty major things that have to happen, and they have to be different. It's not the same thing we did for the previous revolution. It's got to be adequate for this one. And this one happens to be global. So we need policy innovation, we need bold politicians, we need bold policymakers, we need intelligent and serious and deep-going researchers. Now, a unique feature of our time is that the major mid-surge panic happened in 2 episodes. The first one was technological innovation in ICT, the internet mania in the 90s and the NASDAQ collapse. Of course, as I said, the bubble was a lot of financial innovation on top of that, but the internet was set up and by the time the thing collapsed, internet was already a reality. Global internet. Now, the second bubble was financial innovation with ICT. The easy credit bubbles with high-risk shadow banking brought us the 2007-8 meltdown. And understanding this is going to be crucial for identifying the nature, the consequences, and the solution of the current crisis. Now, these bubbles were linked, but they were different, and it's important to understand that, how they were linked and how they were different. First of all, they both concentrated innovation and asset inflation in 2 main areas, technology and finance, but in opposite proportions. If we look at the 1990s and the 2000s, together, technological and financial innovation represented more than half of IPO activity in the US stock markets. So as you can see, we have the major technology bubble, the NASDAQ bubble. 60% of IPOs were technology, but 20% of them were financial innovations. On the other side, in the financial innovation bubbles, we had between 40 and 60% of financial IPOs and about 20% of technological IPOs. So in fact, if you put them together, we're talking about 80% of all IPOs being in these 2 sectors. So maybe you'll say, well, IPOs. First of all, in the second one, there weren't that many IPOs, so it doesn't really say much. So how about capitalization? What was the relative weight of these things? Well, there was certainly a switch in differential asset inflation, but a lot of asset inflation was concentrated in these 2 sectors. So if we look at market capitalization of the financial and technology stocks in the US from 91, which is before the boom, the NASDAQ boom, to July 2008 when we get the crash, we see the same phenomenon. We're talking about $3 trillion in the major technology bubble at the peak, but at the same time we were still talking about financial capitalization around over 2000. And then when we get to the easy liquidity bubble, we're talking about pretty high also, almost 3 trillion and a half in finance, but in technology we also still had about 2 trillion. So between the two, they jointly represented as much as 35% of total market capitalization. We're talking about ICT and finance. So it is a phenomenon of sort of really being the thing. And the same thing if we look at turnover. It is also very much concentrated in these two sectors. But ICT and finance were completely interdependent. Global internet would not have been possible at all without capital gains in the stock market, because that's what allowed to foster full coverage without profits. Of course, none of those companies were having profits, but then you were able to do all that because people were getting capital gains with the asset inflation game. So that's how, in fact, this whole thing works. The housing bubbles could not have been so intense without securitization, which is about software and ICT. They depended on information technology. And without internet, it wouldn't have been possible to trade them globally. So in fact, it is because of ICT that this whole huge global financial subprime, et cetera, was able to grow. Now, we have something which has been talked about today a lot. Of course, Bill Lazonic's work has been very deeply going into this, so I will just give you a very small representation of things. The growth in the profits of financial and non-financial corporations compared to GDP between 1990 and 2007, taking an index 58 equals 100, you can see GDP growing at a reasonable pace, financial profits growing at an incredible, they're decoupling, they're completely off, for even in the NASDAQ bubble, they go completely off, they decouple, that's the phenomenon. They decouple, that's one of the big problems, is the decoupling of finance from the real economy. And of course, the GDP includes them, so it's even worse. And then we see in the second one, they go even faster. But the other phenomenon that's interesting is that the non-financial corporations, as Bill has very much explained, they're financialized. So in fact, that very quick decoupling of non-financial companies, regular production companies from GDP, is another financial problem. So the decoupling is even inside corporations. They're completely decoupled, even internally. So this is the really serious problem that we must solve. Keynes used to say that the most important thing was to reunite borrowers from lenders, the people who were producing things from the people who were just moving money, to put them together again, because that was the main problem. So in the deployment period of the previous surge, just to see how recoupled this was, between 1947 and 71, the boom, the post-war boom, fixed investment regularly outpaced financial credit flows. So we look at private fixed investment and financial instrument flows in billions of current dollars between 45 and 75, and look at that. The bottom line is credit instrument flows. That's finance. Whereas private fixed investment is always more. So it means that during that boom, they were financing our profits. They were reinvesting. And they used, of course, and there were all sorts of things happening with the credit market, but they moved more or less regularly, and fixed investment outpaced it regularly until we have the mess. We have the mess when we have the exhaustion of the technological revolution, when we have the energy crisis and all sorts of things that turn, and then there is all this money flowing from OPEC in the world, and then finance tries to do something with it, and then they start talking about boring finance must be ended, and they ended boring finance, certainly, because look at the next. When we look at the installation period of the current fifth surge from the 70s to the 2000s, finance increasingly decoupled from investment in the real economy. So now we look at the same two figures, private fixed investment and financial instrument flows. There we are. So first of all now, fixed investment is always below, but we see the decoupling periods, which are when we had the venture capital crisis, when we had the 87 precursor bubble collapse. That was another little collapse. I mean, it looks little afterwards.
What do you put inside credit market instrument flows?
Practically everything that the Fed calls credit instrument flows. All the financial things.
So securities and everything else?
I think even insurance. Mm-hmm. Okay, so look at the distance of credit market instrument flows in the financial bubble. It has nothing to do with fixed investment. Nothing. It is completely out of the picture. So this is the sort of thing that we're looking at. So it's two very different periods. A period of stability when the economy is growing and finance is there to serve certain purposes, and of course it will do its own things. And now when there is a real decoupling of those things. So there are three tasks for governments to induce the necessary recoupling after the major crash, to put these things together again, to get Humpty Dumpty back. We have intensive therapy for finance, of course, redesign of regulation and financial architecture, and three, enable a structural shift in the real economy. Now, the first one was done, super overdone. It's been turned into a fiscal deficit, it's been turned, and the banks are there, completely alive, no problem, they didn't suffer from the thing. Truly too much intensive therapy. Then we go to the redesign of regulation and financial architecture. Very timid, everything that has been done with the financial world solving what. But this time, global finance needs both national redesign and indispensably a global regulatory floor. If there isn't a global regulatory floor for global finance, as Soros has always said it, you can't have global finance out there and then each country in their little space trying to control these flows that have nothing, they're not national. Financial flows are no longer national, they're global. And if we don't have a global regulatory floor, it's impossible to control them, and there will be a race to the bottom every time. Anybody who does a little bit of regulation is going to be punished. So we either have a floor or we will not be able to control finance. And that, when I say it's still on the drawing board, it's very optimistic. It isn't even on the drawing board. Now, to enable a structural shift in the real economy, that's even worse. It's rarely being considered as such because there's this whole mad idea that if you get finance to be healthy, we're going to go back to business as usual. Of course not. Healthy finance in a sick economy, in a languid economy, becomes a casino again. So we're just building the conditions for another new casino if we fix finance. We've got to fix the real economy. And that means something very different from just fixing finance. Recovery will be very difficult without it. Now, the length of the process is going to depend on the social and political forces, probably also, unfortunately, on the depth and duration of the recession, which will bring other forces, because up to now, the really strong pressures on politicians come from the financial world. They're the ones that are really strong. They're the ones who fund that beautiful last Obama, that Ron Dore showed us the caricature. Exactly. I mean, they are funding the politicians. They're pushing the politicians. They fund the media. They do everything. So, that's the huge pressure. And then there is the Occupy Wall Street. There is the indignance. There is a little bit of that. We need much more. And we need a lot of intellectual pressure, putting forth the new ideas. So this whole project, I think, is one of the contributors to that. So that's what will determine the length of the process, and of course it also determines the length of the recession. The last time around, it took over a decade and a major war, so we're not talking about something easy. The post-war golden age was unleashed by leaving behind the free market policies of the Roaring '20s and the recessions of the 1930s. Finance was regulated, favoring real investment. Income was redistributed to improve demand profiles for suburban living and mass consumption. It was the achievement of Western democracies to set up a positive sum game between business and the great majorities as workers and as consumers. Is there any possibility of doing something similar now? Is a new global positive sum game possible? I think yes. I think with the technologies that we have, we can conceive of a global positive sum game. It would be made up of the interaction and the combination of universal ICT, green growth, forget about zero growth. Green growth, it's perfectly possible with very high productivity of resources, full global development, which would provide the increasing demand for the green, sustainable products. And therefore, we would have market for everybody. And of course, universal ICT. Today, ICT is the frontier of the global market. Anybody who doesn't have ICT doesn't belong to the global market, and therefore, it doesn't have a chance of really advancing. So, if we look at this, revamping transport, energy, products and production systems to make them durable, sustainable, is equivalent to post-war reconstruction and suburbanization in terms of innovation opportunities and investment opportunities. I mean, it would be a huge boost to any economy. Incorporating successive new millions into sustainable consumption patterns is equivalent to the welfare state and government procurement in terms of increasing demand creation. So we have the supply push and we have the demand pull, the direction of innovation and the volume of demand. That, of course, is only possible if it's green, because we only have one planet, and with high productivity of resources, which is what makes it really green. So we can have many, many times using the same product, and we have durable products and recycle, and et cetera, et cetera. Now, full internet access for all at low cost is equivalent to electrification and suburbanization in facilitating demand and also facilitating supply. I mean, that is the infrastructure of anything that we want to do. Even biotech cannot do without internet. Everything is dependent. Any innovation practically today depends on internet, and it's used also very often. This time, this particular enabling infrastructure also enables education for human capital and intangible services, which should become a greater and greater part of the consumption pattern in society if we are to have a sustainable ways of living. So, what does this all mean? What does it mean in terms of criteria for what government would have to do? The goal of stimulus. It's not just to put money into the economy. First of all, sometimes you put money into the economy and it goes inside the banks, as some people have said today. Other times they just go out of the country. I mean, why would it stay? It doesn't. But to shape, what it has to do is to shape the demand opportunity space, making it profitable to innovate in agreed convergent directions. Globalization, you know, for a long time people were saying globalization is about eliminating national borders, it's over, now we're all the same, it's all flat. No way. Globalization is about differentiating the whole globe Every piece of territory has to have its characteristics, not just what nature gave it, but what policy can give to turn every piece of territory, every nation, every region into something, whatever, in order to attract something. Because the economic units are going to be looking where to locate. And of course we could have protection too for a while in terms of making sure that at some point you get to having a definition. You have to re-specialize. Unfortunately, there is no time to talk about what that means. But we also have to look at what are the criteria for new regulation. What's the goal of new regulation? It is not to constrain finance, but to reorient it. It's okay, we can put the crooks in jail. It's okay, we can take the bonuses away. It's okay, we can regulate and ask for more reserves, many things. But the real goal is to make finance turn away from the casino and move. It should be more profitable to fund expansion and innovation in the real economy than to play in the casino of synthetic instruments and derivatives. Capital gains have to be taxed heavily. Who's going to do that? I don't know. But somebody has got to dare. Because if you don't tax capital gains heavily, and then you make it much better, much more profitable, and very low taxes when you fund the real economy, we're not going to get there. Because we've got to dismantle this huge, gigantic machine of making money from money, making money from nothing, making money from betting, and inflating assets so you're richer if you have those papers than if you have a salary. So what we need is a modern industrial policy in the new global context. Thank you.